I was going to say, I'm sure everybody knows Ioannis, but actually Ioannis was just saying that he's managed to put sort of names to email addresses or faces to email addresses for this. So that's one function of these seminars. So I just also saying that for the first few of these, I could say this is the third or this is the fourth of these research seminars we've held to start. But right now, this is now established. This is the nth, I don't know, 10th or something like this that we've held, and they've been, I think, very popular with staff and been very popular with faculty. So, it's a good thing. And today we have from Ioannis from the Accounting Department, who's going to talk about to save or invest during turbulent times. Okay? You change your title. To save or invest is still there. And you have to do it during times of recession.
Thank you. Thank you. It was not an attempt at cheating or anything, so it is the same material. So thank you to all of you for coming, for taking out this hour out of your busy schedules to come in and hear what we often do behind closed and locked doors sometimes. Kimberly and Stephen, thank you so much for the invitation. So what I'm going to do today is present to you some of my work. Some of you might have heard about me as working in the domain of social responsibility and sustainability. This is my attempt to go a bit beyond that, look at strategy more broadly, particularly as it relates to the recent recession, which because of its extent, people call it the Great Recession. So I would like to keep this quite interactive. So I will have some block of time at the end for questions, but by all means, if anything is unclear or you need more clarifications or any questions or criticism, please go ahead and interrupt me. I'm Greek, I like to talk, and honestly, I could talk the entire hour if I'm not interrupted, and then some more. So, so with that intro, let me tell you the big idea before I go into the details. Now, the big idea here is that often we know a lot and we hear a lot from macroeconomists and economists about how the economy is doing in times of recessions. Often we talk about unemployment, the interest rates, inflation, and investment, and so on. But the thing is that all those kind of concepts translate and have important implications to the way that we teach our MBAs. We think about businesses running their organizations during turbulent times. And you can imagine these are uncertain times. These are times in which investments become risky. Of course, these are times where liquidity and cash flow goes down. And therefore, managers are faced with very real trade-offs in terms of how they manage their business, such that it doesn't only survive during the time of crisis, but it also remains competitive following the crisis. So the big question that we try to answer with this this paper, which is a bit Sherlock Holmes inspired. The actual title of the paper is called "The Dog That Didn't Bark," and if you happen not to remember your Sherlock Holmes, we'll freshen up on that as well a bit later today. So the idea here with my co-author Caroline was trying to understand how did managers handle those difficult decisions during the Great Recession, as their cash flow was going down, as liquidity constraints were binding, as credit was becoming more scarce, but at the same time, while they were trying to not only survive, but keep an eye to the future, keep an eye of what's going to happen right after the recession ends, right? So we talk about the recession. What does that mean? So we call it the Great Recession of 2007, 2009, exactly because it was the largest contraction on record since the Second World War. You can see the similarity, Great Recession, Great Depression of the 1930s. So we call it the Great Recession because it represented the biggest contraction in gross domestic product, and a contraction that hit essentially all of the components of a country's gross domestic product, in particular, which is important, personal consumption. Right? Remember, the crisis started as a housing crisis in the U.S. It affected the equity that people had in their homes. Right? The average drop, imagine in only a couple of years, was more than 15%. In some areas were hit with a reduction in the price of their homes of more than 30-40%. So it was a recession that had profound implications for individuals as well as for businesses. So here is just a graph of how much that contraction was in nominal and in real terms. But another key important thing here is the unemployment rate, right? Here plotted from the Bureau of Labor Statistics, the regular unemployment rate. You can see it peaks at 10% at the peak of the recession. But importantly, and as you see the red line, and unlike other previous recessions, it's just a recession where the long-term rate of unemployment also peaked. In other words, the number of people that are not permanently unemployed, but for a much longer time period remained unemployed. So it was a period in which there was a lot of turmoil, a lot of uncertainty, a lot of unemployment, a lot of a reduction in people's consumption, a lot of reduction in terms of investments, turbulent times that basically we have all lived through, whether the latest one or previous ones. Now, what do we know, academically speaking, about crises, right? Periods of crisis. What defines, what characterizes periods of crisis? Why are they so important to understand, particularly from a business perspective? So what we know is that major economic crises generate significant uncertainty. Once you are in a crisis, typically you do not know when it's going to end, right? Although you do know, if you're a manager, that crisis, there's the business cycle. You have booms and you have recessions, and recession is bound to come. But once you're in a recession, there's huge uncertainty as to the magnitude, or the eventual magnitude of the crisis, as well as the end of the crisis. Secondly, as we see with the financial crisis, this kind of periods spark a major regulatory and policy changes. In other words, in addition to the fundamental uncertainty, they migrate the regulatory uncertainty. How are laws and regulations going to change? If you're in the financial industry, you do worry about how the government is going to react to the crisis, and how the laws that govern the financial system are going to change, for instance, right? So capital becomes, in other words, financial resources becomes more scarce. If it becomes more scarce, it basically means it becomes more expensive to borrow. If it becomes more expensive to borrow, then firms, as well as individuals, are faced with liquidity constraints, the lack of cash. Secondly, there might be huge disruptions in the supply chains, right? Payments might not be made on time. Payments may not be accepted on credit, for example, which delays the entire supply chain and the delivery of the value propositions. Deterioration, and sometimes quite sharp deterioration, of consumer demand, exactly because incomes go down, exactly because personal consumption more generally goes down. There is increased risk of firm failure. In other words, it's easier for firms to go bankrupt during periods of crisis. And to the extent that crises are large enough, they might redefine industry boundaries, or sometimes shut down entire industries and redefine the boundaries of entire industries. So in sum, right, economic meltdowns, economic crises as we know them, they leave little untouched. They leave little in terms of remaining undisturbed by the turbulence in the environment. And usually at companies, they generate fundamental questions about strategy, about short-term survival, but also about long-term profitability. So it sort of shakes the foundations of competitiveness and causes a rethink, a very fundamental rethink of what businesses should be doing or would be doing in order to survive. Now, to start thinking a bit more about, in a bit more detail, how in terms of what businesses do, we need to sort of break down that problem into smaller pieces, right? And in strategy, we have this theory called the resource-based view, which basically says that some firms are better than others. In other words, some firms are more profitable than others, because essentially in their weaponry, they have a set of resources, in other words, a set of capabilities. Some firms might be better at innovating. Some firms might be better at their employee relations. Some others might be better at supply chain management. So a set of underlying resources that are different across firms, right, that generate this performance heterogeneity across firms. So in order to understand those resources, right, we break them down into three categories. Human capital, tangible resources like buildings, offices, plant and equipment, and so on. And intangible resources such as brand and reputation, innovation capability, capability to manage stakeholder relations and social responsibility, and so on. So all this to break down these resources, and you can imagine that in order to maintain these resources, companies need to invest in them, right? you need to invest in advertising in order to maintain your brand. You need to invest in your people in order to maintain employee relations, right? So, and the same applies for tangible and human capital as well. So, but those types of investments, in order to maintain those underlying resources and in order to maintain them relevant for competitiveness, generate important trade-offs exactly during the time of crisis, right? Because in times of crisis, some firms just financial budgets get more tightened, so these investments have to be cut. Because of the uncertainty, right, the risk of some of these investments might go up at the same time, right? And at the same time, even cognitively speaking, a lot of the managers might be preoccupied with surviving the short run and then say, well, you know what, let us just barely go through the recession, let's just survive the recession first, and then we can start dealing with these long-term investments and our pipeline and competitiveness. The immediate threat is, and the immediate need is to survive it's perceived to be to survive in the short run. Therefore, this becomes a very fundamental issue for managers, because they say, well, what should I do? I know that in the long term, I need to maintain these underlying assets. I need to maintain my innovation capability. I need to maintain the relationships with my employees. I need to maintain the relationships with my stakeholders. Therefore, in order to maintain those valuable assets, I need to invest in them. But at the same time, I look at my cash flow, I look at the environment, and I see, well, there's uncertainty. I might not be able to get enough credit to maintain those investments. So how do I manage that trade-off? Right? And at the same time, people can say, well, should I fire people and save money and invest in R&D? Or should I hold back on R&D and invest in my relationships with people? Because then there are trade-offs across different resources, right? For instance, do I delay the building, the buying of new buildings and instead invest in my brand during this time? Should I delay the buying new buildings and invest in innovation? Because in times of crisis, perhaps if I come up with new products that are cheaper or better, I can actually attack the market better if I'm in a time of crisis. So a number of these questions that relate to how managers try to handle the crisis. And of course, we all know the baseline, right? We all know that there are layoffs during crisis. But the more nuanced strategies in terms of R&D, in terms of capital expenditure, and in terms of stakeholder relations are not exactly obvious. Indeed, I'm pretty sure if you asked more broadly, you say, well, what's the first thing you would cut out during a recession in terms of your budget? And some people might say, oh, of course, CSR projects. We cannot afford to have our people volunteer over the weekends, right? We cannot afford to pay above market living wages right now. These are difficult times. Maybe you should cut back. So on the one hand, firms will have a tendency to retrench, to hold back, to become more conservative in the way they handle their spending, right? Which seems to be kind of the more commonsensical view of the world. You know, given times of uncertainty, you become more conservative, you retrench, you hold back until uncertainty is resolved, until the recession finishes, and then you go ahead and proceed with those investments. However, not all firms think alike. So during the crisis, there were some surveys. For instance, this is from Booz & Company at the time. This is the annual R&D survey, and these guys found that in their annual study of the world's biggest corporate R&D spenders, right? So research and development, most of companies have stuck with their innovation programs despite the recession, and many are boosting spending to compete more effectively in the upturn. This is at the peak of the crisis in 2009. So say, wait a second. Some people might say, well, there's another side of things. We say, well, during times of crisis, asset prices go down, things become cheaper. So it might be a good period to invest as opposed to save, such that when the recession finishes, companies that invest are better positioned to be competitive. And this can translate even to corporate social responsibility. You can say, well, according to this argument at least, we say, well, look, companies that stick with their employees, that invest in the relations with them exactly when perhaps their employees need them most, which is in times of crisis, maybe they will fare better after the recession. Therefore, rather than cutbacks, they will maintain their investments, right? And indeed, if we go to some other, what other firms said during this time, this is a big tech company says, when we emerge from this downturn, we'll emerge leaner, more efficient, and more technologically capable. This has been both a business mandate and a cultural imperative for us, again, in 2009. So it's time. Some other firms might say, well, maybe this is the time where we cut the excess fat from the organization. Maybe now is the time to use the opportunity of the crisis to restructure, to cut out inefficiency, to become leaner, to become more rapid in the way we take decisions. Maybe it's the time that we can hire scientists at lower wages, perhaps, right? And then invest in our technology because all wages are going down. Now, some of so we have at least some indications that perhaps the innovation aspect and the R&D aspect may become particularly valuable or at least particularly relevant during times of crisis. Here's what Starbucks was saying at the time. Again, 2008, the CEO of Starbucks said, now is a time to invest truly and authentically in our people, in our corporate responsibility, and in our communities. The argument and opportunity for companies to do this has never been more compelling, right? So in addition to R&D, some people say, well, the relationships are long-term. They're based on mutual trust and understanding. And it's exactly in times of crisis that you don't want to cut back or divest from them. It's exactly in times of crisis that those relationships will become particularly valuable for firms that are able to maintain them, right? And finally, this is where the title of the talk comes from. This is what the CEO of Intel said at the time. He says, you cannot save your way out of recession. You have to invest your way out. We look at our CSR activities in pretty much the same way. You can't just do them in good times and then just forget about them in bad times and hope to get any results, all right? So as much as we see that, some business leaders might be perhaps more forward-looking, might care more about these issues, they say, well, wait a second. Whereas the world might expect us to cut back, to retrench, right, to become more conservative, perhaps we should see this as an opportunity. Perhaps we should see this as the time where we truly invest in some intangibles like my R&D, my innovation capability, my people, my stakeholder relationships, more broadly. So as we were reading with Caroline, trying to understand what farmers do or do not do, it became kind of an empirical puzzle, right? It says, well, on average then, what did firms in the US do? Which ones of these resources did they cut? And which ones of these resources did they maintain investments in? Which one of the views, in a sense, they invest or to save, seems to have been what firms actually did during the recession. So in order to attack that question, we said, okay, we're going to use the classification that we know. In other words, we know that the fundamental pillars are human capital, tangible resources, and intangible resources. And in order to measure intangibles, brand reputation is notoriously difficult to get data on in terms of advertising data and so on. So we broke down intangible resources in terms of research and development capability and CSR or stakeholder relations investments, right? And we wanted to see exactly what did, on average, firms do during the crisis across those four dimensions. Now, going back, before we go into the empirics and see what they actually did, let's take a step back and say, well, why would intangibles, right? Why would these investments in R&D or CSR be particularly important during times of crisis, or particularly valuable during times of crisis? What do you think? Maybe I should open it up because it's been 20 minutes since I've been talking, so I need a break. So why should investments in your people, or why should investments in innovation capability become particularly important in a time of crisis? Why would you want an employer, or your employer, to not to fire you, but actually invest in your relationship in times of crisis? What does that make you feel about your employer, for instance? Loyalty, right? Loyalty, commitment, perhaps increased productivity because of that loyalty and commitment, yeah? What else? Yes?
Training, just you're developing in your people so they're going to get more experience, new skills, etc., and maybe even come up with solutions.
Right, it might be valuable because you say, well, you know what, this is downtime. We have excess capacity, for instance, right? So why don't we put them through training, so some training programs and so on, to improve their skills, to improve their capabilities. So when we emerge from the crisis, again, rather than fire them and then looking for human capital or if you're looking for skills after the crisis, right? Why don't we use this downtime to invest in our people? How about any other thoughts? Yes.
I was just speaking to an employer actually this week, and they said that they had cut all their so they've been cutting their recruitment of MBA graduates sort of 2 or 3 years ago.
Yeah.
And now they haven't got a pipeline.
Right.
Suddenly their business has gone up, and they've got no one to do it.
Exactly, because R&D or capabilities in general for the long run, right? And perhaps some say, well, cutting that in the short run is a very short-sighted kind of strategy because there is if it's one thing that's for sure is that the recession will end at some point, right? Yes.
I was working at UBS during the crisis.
Yes.
Trying to push CSR quite seriously to no avail. And then, of course, as I'm sure everyone's aware, we were tarnished quite severely in the crisis period.
Right.
And they really looked to CSR as part of a brand building, to really support the rebuilding of the brand. And all of a sudden, the budget appeared, the resources appeared, and things started to move in the right direction because it was seen as part of the really core to the strategy to have very senior level board people as well to
Right.
utilize CSR to help the company.
So it might be part of investing in this kind of resources might be part of brand and reputation, and that's important because, for instance, we have evidence that shows that consumers might be less price sensitive. Consumers might be more or less loyal to some of these brands, and perhaps consumers that for companies that care more about their consumers and invest in that relationship, they might enjoy better loyalty and less price sensitivity. What does that mean? It means that when the crisis hits, that's exactly when you want the loyalty to kick in, right? That's exactly when you reap the benefits, so to speak, of your investment. So cutting them will give exactly the opposite signal of what of your original investments. Yes.
Maybe something along what you were just saying, but if you think about how people were feeling during the recession, there's a lot of values that were hurt. People felt really
Right.
out of control, and they felt hurt by values that weren't met. So maybe by showing commitment to the company's values, that
Yeah.
it kind of engages people in that way, on that level.
Right. So in a sense, there's two aspects of this. Investment in the relation might sort of compensate for the broader, let's say, turbulence or the let's say the bad experience that people have, because companies did fire people, right? So how do you motivate the ones that were left behind, right, in order to work and be loyal and be productive and be efficient, things that you particularly need during the crisis, right? So maintaining those investments might, again, become particularly valuable. So those are the kinds of conversations that we had with Caroline, and we went back to what we call the theory, just to understand what have people proven, in other words, in terms of why this kind of intangible resources may become particularly valuable during times of crisis. And we were able to categorize these explanations in at least three kind of big buckets, which I'm going to briefly describe. One is that maintaining investments in intangible resources during time of crisis may enable organizations to become more efficient and more innovative. It might enable organizations to adapt more quickly to the changing demands and expectations, whether it's consumers, suppliers, or indeed the capital markets. And finally, like what we said before with consumer or employee loyalty, right, it might build up organizational resilience. So we argue in this work that it's exactly because of these three sets of mechanisms, maintaining intangible resources become particularly important during time of crisis. So we would expect companies to maintain rather than cut their investments in this kind of intangibles. It's kind of an ambitious agenda here. It's kind of, we thought at the beginning that was much more likely to say, oh, no, there's no way. People were just going to go conservative. People are just going to cut their investments. But then there's many reasons to think why, within these three explanations, why this kind of investments will be particularly more valuable. So this is what I said before, so I'm going to skip that. Here we go. So let's think about efficiency and innovation. right? Indeed, if you continue to invest in R&D, for example, you might find more efficient ways of doing things. You might find new ways of doing things that give you a competitive edge. In other words, you can go down your costs more quickly, which is, again, particularly valuable during times of crisis. Indeed, believe it or not, the iPhone was the result of investments during times of crisis, right? And a number of other GE products, for example, were the direct results of investments during times of crisis. So if you invest in stakeholder relations and tighter stakeholder relations might, again, help you become more innovative, more efficient. For instance, if you have better relationships with employees, your suppliers, you're basically tapping into different sources of information and better so, than a company that might not have such good relationships with its stakeholders, right? And that kind of information is very, very important, because remember what we said, in times of crisis, a defining characteristic is uncertainty. Well, how do you deal with uncertainty? You try to get as much information and as quickly as possible. But what enables better and information and more and higher quality information is exactly investments in the relationships that you have with these stakeholders, right? You need to know how your customers' expectations are changing during times of crisis. You need to know what your suppliers are expecting of you, and you need to have a good relationship so that information reaches you, and it reaches you quickly, right? In other words, the better stakeholder relations allow you for more rapid and more quick and more high quality information to arrive at you, therefore allowing you to adapt more quickly. Now, the other thing is that exactly because the stakeholder relations are based on trust, what does that mean? It means that in a time of crisis, when you need to move quickly, take strategic decisions, maneuver, if you like, in order to adjust the organization more quickly, you need the margin of flexibility. You need the benefit of the doubt. Sometimes you need the external legitimacy and support from your main stakeholders, whether it's a big supplier or whether it's the capital markets themselves. So better stakeholder relations allow you for that flexibility to strategically maneuver and perhaps even tolerate more risk as you take these decisions to adjust in the times of crisis. And finally, the biggest category of explanations is what we call organizational resilience. So this is basically everything we know about why investing in R&D and investing in stakeholder relations is important. But here we explain why all those reasons are amplified, why all those reasons are magnified during times of recession, exactly because of the uncertainty, the increased risk, the reshaping of policies. Think about the reshaping for policies, for instance, right? Better relationship with, let's say, stakeholders in the form of legislators or regulators, right? Means that you may even be able to influence policy as a company, as opposed to having, let's say, the VW sort of relationship with regulators these days, right? If there is trust with regulators, you will be, for instance, on the table when regulation for your industry is being discussed in times of crisis. If you're VW, you will not have a seat on the table. Maybe a seat in jail would be more appropriate, right? So for many reasons, we have a lot of evidence from work that I did and other people did at the school that better investments in CSR are causing better financial performance through various mechanisms. Well, even marginally better financial performance builds organizational resilience that becomes particularly valuable in times of economic crisis. The loyalty of your employees as well as the loyalty of your customers becomes particularly valuable during times of crisis. Let's see the other way around. So if you are a company that in times of recession that everyone knows that you're cash constrained, that you're credit constrained, but then you go out and say, yes, but I'll continue investing in R&D, for instance, that sends a very credible signal of your commitment. It sends a credible signal of how central R&D or stakeholder relations are in your strategy. And this is particularly important in stakeholder relations because some people say, oh, these are the fluffy stuff, these are the tree huggers and so on. But if exactly in the times of crisis where you have the least amount of cash or access to credit, you continue investing, that sends a more credible signal that perhaps you are serious about this, and this is core to what you are doing. So for all of these reasons, I'll go to this data in a second. What we argue in this paper is that, look, the baseline prediction will be that companies will fire people. We know that from macro studies, from macroeconomics, that unemployment shoots up, which means companies will fire people. We also argue that because there will be issues of excess capacity. If the demand goes down, you might have idle factories. If the demand goes down, you might need to become more efficient, restructure the organization, and so on. We also argue that the companies are actually going to cut investments in capital expenditure, in tangible resources, like building new buildings or new offices and so on. But exactly because of these reasons, we say, well, that trade-off that we discussed at the beginning, we argue that, well, they will save the money from CapEx, for instance, from capital expenditure, but they will maintain their investments in intangible resources. Now, we call it this the dog that didn't bark, because essentially what we're trying to find here is a non-finding. In other words, we're trying to detect a non-change in the investments, right? Not a decrease, not an increase, but we're trying to detect a non-change, right? Now, how did we go about doing that? Before I go to the more technical, any questions, any reactions, any opposite views, importantly, that you would like to share? All right. So how did we try to address this question with data? So basically, there's this database called CompuStat that contains information for thousands of U.S. publicly listed, in other words, traded companies in the U.S. So we could detect all this information. So how did we measure all these resources? So first, the human capital was simply a count of the number of employees. And we said, how many did they have in 2009? How many did they have in 2007? And how much did that change, right? So we wanted to see the impact of the crisis on that change. Was it positive, was it negative, or was it neutral? So a positive change means they fired people, right? 2009 minus 2007, and so on. Now, tangible resources, there is this item in a company's financial accounts, which is called capital expenditure, right? So from there, we can get directly a measure of capital expenditure, but companies are of different sizes, right? So we have to deflate that measure to make it comparable. So we deflate that measure by a company's stock of existing resources. Tangible resources. And finally, the tricky part is how to measure intangible resources, right? So in order to measure innovation capability, we used a company's R&D investments, right, which we have annually for every company. Again, we deflated that so that we make them comparable across companies with different sizes. And then in order to measure stakeholder relations, there is this database which we call KLD. It's the most widely used database in academic research to capture what we call non-financial measures, in other words, environmental, social, governance measures. And that includes issues like environmental policies, employee policies, governance policies, human rights policies, and so on. In other words, anything that is non-financial and is not included in the financial statement. So KLD uses analysts that gather everything that the company reports, but everything that everyone else is reporting about the company as well. And they have a number of screens. So they check for environmental violations, recycling, and so on. Human rights policies, human rights violations, supply chain policies, supply chain violations, and so on and so forth. So a range of screens that try to capture in the entirety what the firm is doing and what we call stakeholder relations, right? So they come up with this widely used index that's basically a summary measure that tells you how well or how badly a company is doing. It's a rating, in other words, right? It's a credible rating because it's used by investors to make investments. They say KLD index in the stock exchange and so on. Now, what we did there, similar to the other measures, is that we looked at the index in 2009, and then we looked at it in 2007. We saw that how did it change during the times of crisis, okay? So those are the four categories where we checked what companies actually did. Now, how do we measure the crisis? Right? Is it a 1 or a 0? In other words, did it hit some firms versus others? So here is where things got a bit complicated, right? Because when doctors do experiments, right, they have this thing we call double blind. In other words, some patients get the placebo effect. In other words, they get the sugar pill. Some patients get the actual pill. And then the doctors or the experimenters are able to compare and say, well, actually, the pill causes or does not cause the curing of a disease. In other words, causal kind of, not just to correlate things, but to actually say that A causes B with certainty. Now, you can imagine that in social science, that's extremely difficult to do. We cannot say, oh, this is a real crisis, this is a fake crisis, and we're going to hit the firms differentially, right? But with chronometric methods, we can get close to that kind of an experiment. And let me explain to you how. Now, we know that the Great Recession was the result of the housing crisis, right? But we also know that the housing crisis, right, the hit in prices did not affect all states in the same way. It affected some states more than some others. With that, gives us a nice way of identifying the effects. Okay, we don't have a placebo, a sugar pill, and a real pill, but we have less severely affected and much more severely affected states across the US. So that gives us a comparison that is a more valid, let's just say, than correlation, that can say something perhaps more causal in terms of why firms did what they did during the crisis. Now, yes? We'll get to the sectors in a bit, yes, because yes, yes, we will. So how do we? Yeah, but how do we estimate the house pricing shock? So there is this website like Zoopla in the UK. They call it Zillow. I'm not sure why everything starts with a Z, but anyway. So these guys gathered information of more than 110 million homes in the US, right? So they monitor and they gather that kind of information from mortgage applications, listings, tax filings, and so on. So they, by aggregating up the prices of 110 million homes across the US, they can construct an index, which we call the Zillow House Value Index, every month that tells you, it's like in the UK, right? It's often reported, London versus the rest of the UK, housing prices increases, decreases, and so on, right? But the nice thing about this index is that we can get it at the level of the US, we can get it at the level of the state, we can get it all the way down to the level of the zip code in the US, or the postal code here, exactly because there's so much information that goes into this index. So we can construct this for, as I said before, the different states, and we can see that some states are more severely hit by the crisis, and some states are less severely hit by the crisis. And that kind of variation allows us to identify, if you like, the effect of the crisis on companies' investment strategy. So for your information, during this time and across the US, in other words, between 07 and 09, the hit across the entire US was about 15%, which is a huge hit if you consider the real estate market. And remember, this is the average. In other words, there are states that were hit much more and respectively much less than the average. So what we do, technically speaking, is that we take this hit, right? In other words, the shock to the real estate market, to the housing price shock, and we see, figuratively speaking, how firms reacted across those four domains. There's other technical stuff here. In other words, there are some things you need to consider, control about the size of the firm, its profitability before the crisis, and so on. But rest assured, we control for all those things. So what do we find? What is the main finding here? Is that the baseline hypothesis that we said is that companies did indeed significantly reduce the size of their workforce and their capital expenditure, their investments in tangible resources, right? But here, the main finding, and this is the dog that didn't bark, in other words, no change in the investment, is that companies, the blue circle says, companies maintained their R&D investments and their investments in corporate social responsibility. So it seems that it's not only invest or only save, it's sort of a combination. We see firms maintaining on intangibles but cutting back on workforce and tangible resources. In other words, sort of treating all of the resources that they have as a portfolio that needs to be adjusted during the times of crisis. Again, this is the quote from Sherlock Holmes. You want to have a look? I'm not sure how excited the non-Sherlock Holmes inclined reviewers are going to be about this title, but we'll fight it to the end and see if it stays in. We already published a paper with Olga called Mind the Gap. And you can imagine where that came from. So let's see if this goes through. Anyway, so now let's go to the other important aspect. We said that intangible resources are particularly valuable in times of crisis because they help organizations become more efficient or innovative, more adaptive, or more resilient during times of crisis. Now then the question becomes, well, what did they do following the crisis? How well or how much better or how much worse did they do? Because who knows, maybe the other guys that did follow different strategies invested better and achieved better results following the crisis. So we said, what we did is, well, let's look at the return on assets in the recovery period. In other words, let's look at their profitability and take an average of 2010 and 11, right when the crisis officially ended in 2009. And we use the return on assets, as I mentioned, but also the net profit margin, two measures of performance. Now, what did we try to see is what our basic argument was, is that those kinds of investments, through those mechanisms, were going to lead to a competitive advantage. In other words, we were expecting companies that did not cut R&D and did not cut CSR to do better following the crisis. So this is the outcome. So the first line, if you cannot read it, I apologize. It says, companies that did not reduce R&D only, right? Those companies did 34 or 67% better following in the recovery period. Now there's those that did not cut CSR, and there we see another 9% or 23% in terms of the net profit margin, doing better in the recovery period compared to the ones that did cut R&D and did cut CSR. Now, the interesting thing is, let's look at those companies that did not do both. In other words, companies that maintained both their R&D investments as well as the investments in stakeholders. In other words, their investments in CSR. So we go for those companies, you see the numbers dominate both. In other words, they did 53 and 78% better financially in the recovery period compared to other firms. All right? And we hope that, you know, by looking at what firms actually did and also seeing their post-recession performance, we again begin to understand what strategy during the business cycle begins to look like. Yes?
Does it become self-selection that those that could afford to maintain their R&D and CSR investment were the ones who were typically well run anyway because they had the reserves, where those that were poorly run
Yeah.
didn't have reserves and therefore self-selected themselves out in the time of crisis?
Well, yeah.
Couldn't afford to do that, and therefore they were underperformed, but they underperformed to start with.
Right. So remember that we, as I mentioned, the controls, we controlled from where they started. So we controlled for how profitable, how leveraged they were, what kind of debt they had, and all that at the beginning of the crisis. Now, on top of that, remember, these are the guys that did not cut their investments. In other words, they were able to afford to maintain the investments. Right?
That's what I mean. So the ones you couldn't afford to.
Yes.
You're saying the whole.
Yeah. Well.
Afford to.
Right. No. I'm saying that.
Could afford to.
On average, they did, right? That's why the results I showed you before is for the entire sample. Here, I want to see the ones that in particular did not cut it, both of them, right? Because the sample, it could be a combination of both, right? All right. Now, you asked about industry sector changes, and this makes a lot of sense because for some sectors, right, stakeholder relations are going to be important. For other sectors, stakeholder relations are not going to be material. For instance, in sectors where human capital is important, you can see that broader stakeholder relations are going to be important. And similarly for R&D, there might be sectors in which innovation is critical, but there might be sectors in which innovation is not critical. So because we have all these industries and sectors in our sample, we can test for that. And if our mechanisms are close to being truth, we can say, well, if these mechanisms that we argue for hold, then we would expect in industries where stakeholder relations are not important, that companies actually cut their R&D, and we can, or their CSR, and we can also say the reverse, that in the top quartile, in other words, in industries where CSR is particularly important, or R&D is particularly important, not only did they not cut, but they actually increased their investments in R&D and CSR during times of crisis. So we tried to break down industries in terms of how important R&D is by taking an average across all firms, and then we rank the industries, and then we take the top quarter, which is the most R&D or most CSR intensive industries. And there's another check we had to do, right? Because someone can say, okay, fine, but look, R&D investments, they take years. Stakeholder relations may take years. This has nothing to do with the crisis. It might be because these are just sticky investments, right? Because of long-term sticky investments, so firms just maintain it. So in order to check for that, we said, well, why don't we look at firms that were particularly financially constrained, right? Those that could not, as you mentioned, did not have the financial resources. Did they behave in the way that we expect them to behave? So all this, as we call the robustness checks, just auxiliary analysis to make sure that the mechanisms that we argue for are particularly true in the context in which we expect them to be particularly true. So companies in low R&D intensity industries, we do find that they decreased their R&D investments. The reverse is also true. For the top quartile of R&D intensive industries, companies increased their R&D investments. Similar for CSR. In low CSR, in other words, in industries where the stakeholder relations investments are not material, firms went ahead and diminished their investments. But at the top of the list, in other words, in the industries in which CSR investments stakeholder relations are material, firms maintained or increased their investments in CSR. And finally, for both of these, the companies behaved exactly as we'd expect them. In other words, if indeed they were financially constrained, and we can measure how financially constrained a company is, they did reduce both R&D and CSR. In other words, getting away with that stickiness argument, because when they did face the financial constraint, they cut it, right? So it's not the stickiness of these investments that may drive these results. All right, so just to conclude, so what did we try to understand here? We tried to understand what companies actually did in their latest financial crisis. As you might have seen in popular press, on the news and so on, there's a lot of talk about the economy as a whole, and rightly so, about inflation, interest rates, and so on in times of crisis. There is much less talk about firm strategy during times of crisis. And you can imagine that it's particularly in times of crisis where strategy generates important advantages, or trade-offs become particularly binding, and managers and executives need to take important decisions. So what we wanted to do in this paper is sort of open this black box, because believe it or not, there's not really much out there, at least in our academic world, that explores down to the firm level what firms do in times of crisis, despite the regularity of crisis, and despite the fact that the manager is bound to go through a couple of crises during his or her career. Right? So we tried to answer this question with the latest crisis and said, what did firms actually do? And we argued that they are going to maintain their investments in intangible resources, exactly because these are the resources that become particularly more valuable. They're going to have to face trade-offs, and therefore they will cut on the workforce, which is our baseline prediction that we know from macro, and CapEx. And at the end of the day, those firms that maintain their investments in intangibles are much more likely to correlate with better performance following the crisis. All right. I had to use this slide. It's one of my favorites in the deck. So, any questions, concerns, clarifications, comments, anything? Yes?
How big was Recession?
It was about 3,500 US firms, which is basically the entire universe of US firms that report in that database. So the largest firms and everything is, and all of them are included. Yeah. Yes?
So if I might be understanding it incorrectly, but so the firms that maintain or increase in intangible resources show better results as they come out?
Not increase, just maintain.
Just maintain. So if, does it follow, if they increase, they will do even better? And there's some, you know, if you've got like a magic sliding scale, you know,
In
don't
academia,
maintain
we would say that question. You're asking me to make out of sample predictions. In other words, it is probable, but as everything, there are trade-offs, right? In other words, I would expect that as in anything, you cannot just increase something and get more and more and more better of the other. At some point, there should be trade-offs. There should be diminishing returns. There should be a saturation point, right? Where an optimal point through which you cannot invest. So it is probable, but I don't think we can answer this question, at least with this data.
And
Likely.
also out of sample, because that only applies to that Great Recession period, but have you done any other work around, you know, what the impact of that sort of investment, not increases? I mean,
Right. So a lot of the theories that we bring to explain why in crisis these are particularly important comes from work that says in general why these investments are important. So yeah, a lot of my work is understanding, well, what is an organization that integrates environmental and social issues into its strategy? How does its governance change? How is stakeholder engagement change, and so on and so forth? There's a lot of work for that, which we leverage, but we need to extend the argument by saying why that in particular in crisis becomes important. Yeah. Another, yes?
You studied the US. Why didn't you study Europe?
Because
Do you think it would be different? Is there a different mindset in European companies?
Yeah. So we started with the US. Starting with is a slightly a technical reason. Remember, I told you about the difference with experimentation, right? So in order to be able to say something that is beyond just correlational, we needed to have this variance in the severity of the crisis. So because the crisis in the US originated as a housing crisis, we were able to detect more and less severely affected regions, and therefore make that comparison in the background is what allows us to say what firms actually did. Now, the reason why I think there is not enough work in general on recessions is that if it's not a housing recession, and then all the companies are hit the same, there's no way you can say something beyond correlation. In other words, if I give everyone the same pill, right? I don't know for which people the pill works and for which people the pill doesn't. So you can imagine a recession that doesn't have that regional variation as the equivalent of giving everyone the same pill, right? So I don't think we had housing price variation enough in Europe to be able to, let's say, econometrically identify that effect in Europe. Yes.
So just a point of clarification, this was all publicly traded companies?
Yes.
I was wondering about the impact of, the ownership structure, because of course some of the points you mentioned in terms of benefits, access to finance, so those companies don't have the, try to be a shareholder friendly.
Right. No, we haven't looked at that. We haven't looked at changes in the ownership structure, because this was kind of the platform to start exploring kind of the crisis. But you can imagine that it opens us a range of questions. Let me give you an example. The governance is a very important one and how it perhaps changed over the crisis. But let me give you another one. Even within these pillars that we talked about, workforce, we found that workforce on average goes down, right? But this opens a can of worms because they say, well, who did they fire? Did they fire skilled or unskilled labor? What did they do for the ones that remained behind? Did they invest more or less in the employee relations, right? And the same thing with R&D projects. Which ones did they readjust? Did they readjust their long-term R&D projects or their short-term R&D projects? Which ones did they maintain? Was there a reshuffling, perhaps, of R&D projects during the crisis. That we cannot yet observe. Here we can only see average effects at the level of R&D in general or workforce in general. But believe it or not, we don't have enough research that goes into one of those quite fundamental pillars for any company to understand exactly what they do and why they are doing it in recessions. Was a question? No? Yes?
Another question would be communications. To what extent that investment in CSR or R&D was communicated both internally and externally? Yeah, because that will also could have impacted their results in the end, depending on whether their communication strategy was effective, right?
Right. Yes. So you're going a bit more micro within the organization,
but
right?
also externally to other stakeholders, which could also impact the results on the market.
So the degree to the degree that they communicate externally, all that communication is summarized in the KLD index. Okay. Right, from company self-reports as well as, let's say, what NGOs report about the company, what the government reports about the company, and so on. So all those, especially the non-financial stuff, is captured by the KLD. That's why I call it stakeholder relations more broadly. Yeah.
Do you think it's predictive in any way? I mean, the next recession we go to, would you be looking for companies that specifically, if you were an investor, for example, would you be looking for companies, an investment analyst, that would be the question that you'd be asking?
Well, the issue of prediction is a tricky one in academia, isn't it? It's not like, as in strategy, we don't do investment strategies and finance and so on, but I think what is I wouldn't say predictive, I would say prescriptive, is the general principles that we're able to extract from these findings. In other words, why are intangible resources particularly valuable? How do they help a company maintain or improve its competitiveness? So those more general learnings, yes, I wouldn't call them predictive with respect to a particular company, but I would say that those learnings generalize beyond the context of this particular recession, in the context of intangible resources more broadly, in the context of managing under extreme uncertainty, whether we want to call that a recession or some other type of uncertainty, and so on. So to that extent, yes, there are general findings that go beyond this particular crisis and the US context. Yeah, it's what we call theoretical contributions, if you like. Yeah.
No question.
Yep. Anyone else? All right. Thank you so much for your attention. Thank you. Thank you.